Hello, good morning. I'm God's time. Okay, we were looking at the BMC last time, business models, the business model canvas. There's some information I did not drop. Actually, the BMC is a wide stuff. Yes, the BMC must not just contain just the market structure, because if we are only looking at value proposition, talking about market segment, talking about channel of business, talking about the revenue, we're actually looking at the market structure. So, but the business model canvas is aside that. We also have the financial management and we also have the operational cost. In the operational cost, we're talking about the managerial outlets from the founder, which is the chief executive officer. We also talk about the manager, which is the head of the board, the human resource manager itself will receive instruction from the manager. We'll talk about other outlet structure, depends on the nature of the business. If it's an industry, we might be talking about the HOD of each department, the supervisors, and others that gets the activities well structured. That is uh, operational management. So the BMC must contain both the financial management, the market management, and also the operational management. So, but let's talk about the financial management very well today, and also look about how to finance the enterprise in general. So, when we talk about the financial management, we're talking about the income statement, the balance sheet, and the basic accounting statement. And the income statement, we're talking about the assets, the liability, and the equity. So, liability plus equity plus assets give us equity. So, what is assets? When we look fully on financing the enterprise, I will talk more about assets there. Assets, in example of a fixed capital, like the land that is a fixed capital. When we talk about equity, we're talking about what the person is bringing to the business, like a bank. For example, bank does not give loan; they give loan in equity structure. What this person have? Sometimes your car, sometimes your money, the capital you are bringing to the business, what you have at hand. So that's what is called equity. Talk about liability. Yes, talk about liability. We look at liquidity and solvency. Liquidity means your short-term loan. When you go to the bank to seek for loan, your short-term loan, and solvency, your long-term loan. We also talk about profitability under liability. Under liability, we also talk about profitability. That is under balance sheet. So to understand the balance sheet statement fully, look at liquidity, solvency, and profitability. So I will just dive into our main concern, financing the enterprise. So financing the enterprise, you must know your assets, your fixed costs. You must know your fixed costs, your working capital, and your estimated costs. Your working capital are those daily money that are involved in your business. They are all called overheads. They are all called overheads. So how do a business know how to sell its product? People don't just fix price on a particular goods. No, they fix price on the goods due to its cost or the overhead. So you have to know unit cost of a particular product you are producing. So do that is all your overheads, your fixed capital, your working capital, your estimated cost, all your overheads, your logistic, working capital, your salary, the salary of your staff, machinery that are in placement in the sector you are operating in, all the overheads. Divide by the volume of what you have produced. If divide by the volume of what you have produced, that will give you your unit cost. And when you have got your unit cost, you can then know what your unit profit is going to be, your unit sale, so your unit profit. So to get what your unit profit, the price per unit of the product is going to be that cost you have already gotten, divide by the volume again. So it will not help you to know how much you are going to sell the goods. Not as if when you know that you have actually gained the profit in that enterprise. No. So for you to get your revenue now, the goods you sold, you are going to minus it by the volume. That is your revenue. And that is what most businesses are aiming at every year, their revenue. But it will shock you to know that that is not actually what the business gain that year, because many people are invested in that year. Like when you look at your balance sheet, see that there is liability as also. Either it's liquidity, solvency, you might have to settle them. And people that are investors that have share in your business. So what do I do in such a case? So that's what they called gross income and net income. People prefer going to business. If you are in the private sector, where you are working for salary, the government will normally take, sorry, the public sector, the government will normally take your gross income, which is the largest income. So I will take time and explain income statement in a wider view, maybe one of those days. So your gross income, now how do I get my goal? Your gross income is where your gross income and your net income is the two segments of your revenue. So now the one that belongs to the organization is the gross income, because the net income is where the shareholder stake are, the salary are, because under your overhead, salary was involved as working capital and all that. So your revenue is now sectioned into the gross income and the net income. So your gross income is now going to be the revenue you have already gotten minus the volume of product. That is your gross income. Now, the leftover money is now your net income. This is where you feed other purpose, like you pay your people that have shares in your business, your salary, your logistic, your power, electricity, all your overheads. That is where the net income now settled. So your regain in that industry at that time is actually the gross income that the company is able to ascertain. Thank you.